The United States has been the driving force behind the global capitalist economy for over a century. However, recent evidence suggests that America's once unrivaled economic preeminence is gradually eroding, as developing nations like China continue their rapid ascent. Critics argue that globalization has caused a disproportionate benefit to rival nations like China through unfair trade practices, and this has led to a decline in American prosperity. In contrast, the US remains the world's largest economy as of 2021, with a GDP of $23 trillion. China's GDP has grown by almost 10% annually over the past decade, and currently stands at $17.7 trillion. When adjusted for purchasing power parity, China's economy is estimated to be larger than America's. The International Monetary Fund predicts that China will overtake the US to become the world's largest economy within the next 5-10 years, even in terms of nominal GDP. Other developing countries such as India, Indonesia, Turkey, Thailand, and Brazil are also rapidly emerging. The current view is that technology diffusion and global financial integration enable poorer countries to benefit from trade. With improved education and infrastructure, more people in these countries can engage in value-added economic activities. Advanced economies outsource manufacturing and services to optimize labor and material costs. Workers in emerging markets benefit from rising wages and better working conditions. Developed nations' consumers have access to cheaper imported goods and services. This creates a win-win situation that boosts global growth. However, some economists contend current globalization patterns are far more imbalanced. They argue it has predominantly allowed competitor countries to harness America's own innovations and central position in the global trading system to eventually displace it. For US firms, outsourcing production and services to lower-cost countries has been hugely profitable. Corporate earnings have surged from accessing cheaper labor, materials, and lower regulations overseas, along with new consumer markets abroad. Chinese factory and service workers have certainly benefited from rising wages and better conditions, and consumers worldwide enjoy lower prices from production shifts to developing countries. But this has also systematically gutted America's manufacturing base, with technologies and skills developed domestically transferred overseas. China now leads in sectors like 5G, AI, high-speed rail, EVs, lithium batteries. US consumers benefit from cheaper goods short-term. However, the lasting erosion of these industrial capabilities undercuts America's economic leadership long-term. Moreover, American workers in import-competing industries have faced stagnating incomes from competition with lower-paid emerging economy labor. Developing countries can exploit more lenient environmental and labor regulations to undercut costs. America's exorbitant military spending to secure global shipping lanes and uphold the petrodollar system predominantly benefits other nations free riding on this public good provision. Another structural shift is overconsumption at the expense of productive investment. In the 1960s, personal consumption was around 60% of GDP, with investment about 40%. But today, consumption makes up 68% of the economy, while investment in infrastructure, skills, and technology has fallen to just 32%. Contrast this with China, where domestic investment remains around 45% of GDP, far higher than other major economies. Vast sums continue to be directed into infrastructure like high-speed rail, state-of-the-art ports and airports, 5G networks, and power generation. While some projects are wasteful, this builds future productive capacity. America's underinvestment in infrastructure and skills undercuts competitiveness. Chronic trade deficits are another concern, with America importing far more than it exports and consuming beyond its means. The overall trade deficit hit $1.1 trillion in 2021, with nearly a third of that just with China at $380 billion. These deficits are financed by other nations buying US Treasury, loaning America money. China owns over $1 trillion in US debt, giving it financial leverage over America's debt-driven economy. Faced with such stark evidence, some economists like Dr. Moyo have proposed radical solutions like America defaulting on its Chinese debt and closing itself off from trade to focus on domestic production self-sufficiency. While extreme, this highlights deep unease over how imbalanced globalization patterns have become, with competitors seemingly benefiting more than America itself. More pragmatic solutions include tax incentives to restore key technologies, goods, and services currently outsourced overseas. Promoting vocational skills training could also help rebuild America's atrophied manufacturing base. Carbon taxes on imports from countries with loose environmental regulations could also help level the playing field. Reducing financial linkages between the US and China also appears to be underway in sensitive technologies. Globalization has been been a significant force in expanding the global economy in recent times. It has opened up new markets, created jobs, and facilitated the exchange of goods and services across the world. However, the benefits of globalization have not been distributed equally across all countries, and America's share of the global economic pie appears to be diminishing as China and other competitors rise. To maintain its economic leadership, America needs to reassess its approach to globalization to ensure a more balanced outcome. This will require a deliberate effort to address the underlying structural issues that have contributed to the country's declining share of the global economic pie. These include a lack of investment in research and development, unfair trade agreements, and a shrinking middle class. The coronavirus pandemic has had a devastating impact on the US economy, leading to record high unemployment levels and an unprecedented contraction in GDP. In response, some have proposed that the government should implement a complete shutdown of all non-essential businesses and activities in order to revive the economy. While this approach may be effective at containing the spread of COVID-19, it is likely not enough to revive its economic growth on its own. The question of whether the USA should shut down to save its economy is complex and requires a careful analysis of the potential impact on trade, employment, and GDP. While a government shutdown could reduce GDP by 0.2 percentage points weekly, international trade, despite its costs to employment, contributes significantly to the US economy, making shutting down impractical. Instead, investment in R&D, fair trade agreements, and middle-class expansion are recommended. Government shutdowns are not a desirable economic solution, as they have negative effects on fourth-quarter GDP growth that vary with duration. Shutdowns can impact federal employees, reduce government consumption, affect unemployment rates, and contribute to stock market declines. Therefore, a short shutdown may not wreck the economy, but it could cause real damage. Despite historical trends, experts note recent contributions to a 5% dip in the S&P 500 and mutually beneficial outcomes from the international systems it was pivotal in creating. This highlights the importance of maintaining a responsible approach to globalization that balances the interests of all countries involved. Rather than relying solely on a complete shutdown strategy, policymakers should look towards other measures such as targeted fiscal stimulus packages or financial assistance programs for small business owners. Such approaches can help support individuals who have been affected by job losses, while also providing incentives for companies struggling with cash flow problems due to reduced demand or supply chain disruptions caused by lockdowns. If implemented correctly, these policies can go a long way towards helping jumpstart economic activity without having too great an impact on public health outcomes either directly or indirectly. Ultimately, while shutting down certain sectors may be necessary during times like these, it cannot serve alone as a long-lasting solution when trying to revive the US national economy.